Today is Sunday, October 18th, and this is a post-market review for the stock market activities on Friday and an outlook for this upcoming week. We do have plenty to discuss today, everything from the market's performance this week to the options market's activities, and of course important headlines that we had throughout the day on Friday, specifically the retail data we got on Friday, which was of course celebrated by the financial media and the administration. However, I think that the results or the data we got on Friday resembles a peak, and I do have the evidence in my hand. I will share that with you in the headlines segment. And of course, we do have weekly charts for the SPY, the Qs, the dollar index, gold, VIX, treasury yields, Apple, and Tesla. And here we go, the Dow Industrial Average closing in the green by 112.11 points, or a gain of 0.39%. The Nasdaq in the red by 42.31 points, or 0.36%. S&P 500 in the green barely by 0.47 points, or a gain of 1 basis points. What's going on with the sector's performance? For the day, we see utilities, healthcare, and industrials led the day, and the laggards are energy, real estate, and consumer cyclicals. How about the weekly performance? Communication services gaining the gold medal, followed by silver for consumer cyclicals, and the bronze goes to utilities. The laggards of the week: energy, real estate, and basic materials. What happened in the futures market on Friday? Here it is. For softs, sugar and cotton having a pretty good day, while OJ, coffee, and lumber in the red. What about metals? Modest gains for silvers and platinum. However, palladium led the decline in metals. Meats, bad day for feeder cattle. Likewise in grain, rough day for rough rice and soy products. However, wheat managed to outperform in the grains futures. And moving on to the options market, right away, Apple leading the volume by 2 million contracts. 67% of those were calls. Tesla at 935,000 with 63% calls. How about NEO at number 3? 900,000 contracts with 71% for calls. Of course, Tesla has earnings coming up this upcoming week, and we didn't see notable activities in the change of open interest, so we'll move on to interesting trades and let's check out what we found for the trades conducted on Friday. Here is an interesting trade for Under Armour. They're buying the $12 put. It is a big bet for next week, betting on massive decline for Under Armour. Here is another trade we found for ExxonMobil. It is a bullish trade expiring October 30th. And they're selling the 30 puts, using the proceeds and buying the 37.5 call. So a big range here in terms of delta, but it is very strong bullish bet for the energy sector, specifically ExxonMobil. Here is another interesting trade for Alibaba. They're buying the 360 calls expiring November 20th. Obviously very bold call because Baba is not trading anywhere near 360. However, is this a bet that Biden will win the presidency and Chinese stocks will soar after the elections? Perhaps this is how I read this trade. We also saw notable activities in Wynn Resorts. Bullish activities, specifically here buying the 80 call expiring November 6. We do have casino earnings coming up as soon as this week with Las Vegas Resorts, and I saw a lot of activities for bullish calls on Wynn Resorts specifically. And lastly, here is another interesting trade for Apple, buying the 98 put. So we're talking here about 20% decline for Apple, expiring October 30th. So perhaps the trader is bearish here and betting on a big decline for Apple, not necessarily all the way to 98, but let's say that Apple declines to 108, 105. This trade, the time value in it alone will make it very profitable, and the trader will close the trade and book the profits. But the outlook for Apple is very bearish, specifically when you look at the charts, and we will do that in just a little bit. But for now, let's move on to the heat map analysis. And right away, this is the daily heat map analysis for Friday. You see the notable decliners are Apple and Amazon, not so much Facebook and Microsoft, so underperformance here from Apple, Amazon, and Netflix, by the way. So did Tesla. Tesla underperformed. So we see that gambling crowd's favorites here not doing so well. Here is an interesting activities in the heat map. Apparel retail. Now, you would think that the upbeat number that we got in the morning on Friday for retail sales would boost the sector of apparel retail. However, it did the contrary and the sector traded in the red. And I will explain to you why the retail sales data that we got for September is the peak, the top. Continuing, you see Uber not doing so well, and I told you about my bearish trade against Uber a few days ago, and right away you see Uber declining. Clorox, another name I'm shorting, and you see Clorox declining on Friday. What about the outperformance for the day? You see Autodesk with big gains. Pfizer, there are news about Pfizer that we will discuss on the headline segment regarding the vaccine. But if you do remember, on Thursday, we caught a trade in the options market, betting for Pfizer on the upside, and right away you see the news about the vaccine came out on Friday morning. Somebody knew something, we caught the trade, and you see it right away. Of course, another trade we covered that particular day was for Nikola, a bullish trade for Nikola. Somebody made a bullish bid, expecting, of course, the cancellation of the Badger to be good news for Nikola, because all the controversy in Nikola started with the Badger. And this particular trader had insider information that the Badger will be cancelled, and he or she thought that this would be good news for Nikola and will force short covering. However, you saw Nikola getting whacked severely on Friday, so that particular trader ate a massive uppercut. However, the person who sold, or the entity who sold those options, get to keep the money. Continuing with the gainers for the day here in the heat map, you see outperformance with Regeneron, Abbott, and a lot of the vaccine and COVID treatment names. Zoom outperformed not just the day but for the week. I told you before the week started that we will see an outperformance by Zoom. So if you followed my advice, you bought calls on Zoom, you did pretty good. Baba having a great day on Friday, so did General Motors, CAT, and GE. CAT specifically is very interesting because it could be a bet on a Democratic sweep, a blue wave, a bigger stimulus, massive construction projects that would ignite the growth in CAT shares again. And we do also have Boeing outperformed on Friday. There is news about Boeing. We will cover that in just a little bit. But before we do that, let's move on to the weekly heat map performance. The decliners led by cruises. Not good week for cruises. Beer declining. We've seen beer having a good week last week, but this week they're giving the majority of the gains away. Eli Lilly had bad news about their treatment, and of course the pauses in the trials, and you saw Eli Lilly getting whacked this week. Oil across the board, banks, but specifically Wells Fargo. We do have a name, Vertex, had bad news about their own treatment and drugs, and that name specifically dropped double digits this week alone. Uber, we discussed that, bad week for Uber overall. So what did outperform this week? We do have BlackRock and Morgan Stanley on the heels of their earnings. Chips outperformed, PayPal outperformed, but it is notable that Square lagged here. And we've seen bearish activities on Square in the options market, and the charts suggest that we are nearing a top in Square. Now, will PayPal follow through? I think so. And if you see Square declining, you bet that PayPal would decline as well. Pfizer having a good week. We discussed that. So did Spotify, Zoom, the video games names like Activision and Electronic Arts. Costco having a good week. Of course, the resurgence of coronavirus. Where do people go? Kroger and Costco. Two good names to buy if you're bidding on a resurgence of COVID-19. Auto manufacturers like General Motors and Ford had a good week, so did FedEx, Caterpillar, and General Electric. And of course, we've seen a lot of activities for General Electric buying calls, and this is the result, of course, of buying lots of call options and causing a gamma squeeze in the name. Moving on to the rotation trade. What happened from a weekly perspective? What you're looking at right now is the weekly scoreboard. Remember, we talked about the outperformance of Zoom before the week even started, and you see Zoom outperforming the stay-at-home stocks. Of course, I did not know about the resurgence of Corona, but the technicals alone were enough to predict a comeback in Zoom. Zoom lagged last week, and this week you see it outperforming. What about Peloton? Peloton lagging Zoom, but still had a good week overall. However, I think we are very near a top here, and the reversal in Peloton very imminent, specifically after some bad news we've heard about Peloton. We'll talk about this in a little bit. You gotta be patient, but the drop in Peloton will be very epic here due to the options market activities and of course the rush to unload all the shares accumulated during that period. Now for the reopening names, you see the vaccine related names got hit very hard. These are the vaccine dependent names, shall I say. Royal Caribbean, Six Flags, Live Nation, but cyclical names that are not so dependent on vaccines and are actually benefiting from the upbeat and boost in retail sales such as Ulta Beauty and General Motors. And now to the headlines that shaped the day. Right away in the morning, we've heard another vaccine optimism pump from Pfizer. Pfizer now seeking an FDA approval for their coronavirus vaccine in November, very soon. We've also heard from Boeing, news about Boeing, the European Commission approving the 737 MAX to fly again. Of course, it is one thing for the authorities to approve the plane. It is another story for passengers to be convinced to travel on that flying coffin. And here is the news about Peloton. Peloton is recalling a big number of their bikes due to a fault in the pedals that caused lots of injuries, and these injuries were severe in many cases and required hospitalization and medical treatment. Very bad news for a company that sells $3,000 bikes, yet the pedals don't work properly. I have a $160 bike. The pedals work just fine. It takes me to the beach and I can cycle around on the beach wearing my mask. No problem. I don't need to have a stationary bike at home that costs $3,000 with pedals that could chop your feet off just so I can look at the screen and hear some cult leader shouting and yelling at me, trying to motivate me. And now to the most important news of the day, the retail data that we got, the retail sales data, I should say, coming in at 1.9% month over month versus 0.7% expected. Right away, the media had a massive orgasm over this number, celebrating the number, touting the V-shaped recovery, that we're out of the woods and the consumer is very strong. And of course, this is the zombie mentality of these experts, quote unquote. They're too lazy to read the details and they're too lazy to apply any critical thinking. Let me illustrate to you what I mean by this example. Suppose you operate a donut shop and business is slow and you're not selling your donuts like you used to anymore. All of a sudden walks in a fat cat, a whale, and buys all the donuts that you have for a given day. And now you sold out. You closed the shop because you got no more donuts to sell. On paper, if we ask you, how are your sales going? You would say, oh, in this particular day, my sales are going great. I am sold out of donuts. But when we look at the details, it is one fat cat that ate all the donuts. Meaning that unless this fat cat continues to show up every day and buys the entire shop full of donuts, your retail sales, or your donut sales in this case, will drop again. Because in a healthy economy and in a healthy consumer spending environment, you need the purchasing power to be distributed among a wider and a larger pool of customers. Ideally, you would have 100 customers per day buying one donut each, rather than having one customer that buys $100 and closes the shop, or buys 100 donuts not dollars. And this is what we see in the retail environment. We do have the haves versus the have-nots in the economy. And if the haves are the ones spending and boosting retail data, well, there's only a limit to where they can sustain that boost. Meaning, think of a company that relies on consumer purchasing power, such as Apple. Now, Jeff Bezos is not going to go ahead and buy 1 million iPhone 12 and distribute it to the people out of the goodness of his heart. He only needs one phone, even though his purchasing power is very, very high. But he needs only one phone. So he buys one phone, and if the rest of us are poor, and we don't have disposable income, and our spending power is down, guess what? This is bad news for Apple. So it is one thing to look at the data from a lump sum position versus when you dig in details and you apply some critical thinking of how would that impact individual companies. For Apple to have excellent sales for the iPhone 12, we need a very healthy distribution of consumer purchasing power among a large pool of the population, not just the haves. Very important. Furthermore, let's discuss the psychology and the consumer behavior during the COVID-19 lockdown. Here is what happened. The first phase of spending happened right after the closures or the lockdown were announced. What happened in the economy is they shut down a switch right away, and you saw everything collapsing or falling down. What's not going to collapse is the savings and the salaries and the disposable income for people who did not get fired and were still employed at that time. We're talking around March and April. Not a lot of people were fired right away. So what is the knee-jerk reaction and the very expected reaction from the consumer? The first phase was hoarding, and we hoarded essential supplies. Food, water, Clorox wipes. We panicked. We were preparing for the zombie apocalypse. Just look at the shares of Generac. People were buying generators like hotcakes. Remember, this is a phase where most of us were coming out of a great economy, at least on surface, and we had lots of disposable income and purchasing power. And then we moved to phase 2, where we realized that we're going to stay at home for the foreseeable future, so we might as well use our spare time to do some home improvement, pick up some hobbies, gardening, and you saw guitar sales spiking. You saw the sales in Home Depot and Lowe's surging significantly because the entire population picked up gardening. And I've been gardening for a while before COVID, and I know the spike in gardening because I watched certain YouTube channels for gardening, and the views surged significantly during March, April, and May. And then we moved in the phase 3, which is we now know that we're going to work from home for longer than we expect. So what happened during that phase? We bought iPads, laptops, electronics, coffee machines, and of course you saw the quarterly earnings for Apple showing a significant surge in buying iPads and Macs. Now remember, at each phase, our disposable income and purchasing power dwindles because we're spending what we have from our reserves. And either you replenish the reserves if you are employed by saving more, or if you're not employed or if you're underemployed, you need stimulus. And right away you see the effect of stimulus the first time around, boosting all of that spending in the economy. And we saw phase 4. Phase 4 was the reopening phase for many states in the country. We saw outdoor dining. People went out to spend in restaurants, leisure. They bought cars. You saw the auto sales spiking significantly in August and September. Now the next phase is holidays spending, which we are getting into with depleted reserves since stimulus did not pass, and unemployment benefits, which in many cases paid people more than what were they earning before they lost their jobs, further increasing their spending power. But now the unemployment benefits are gone. So we reach the fifth and the last stage of the consumer behavior, which is exhaustion. Meaning your reserves are now depleted, you made most of the purchases that you need, and you're fully stocked, and people who are not fully stocked, the have-nots, they don't have any purchasing power left. Meaning without stimulus, that V-shaped recovery that they've been touting will hit an air pocket and it will become something like a W instead. Furthermore, the retail sales data we got on Friday was a peak. This is my opinion and my analysis, of course. And here is my proof. You see that personal expenditure in the economy is plateauing and not doing a V-shaped recovery as many expected, even with the stimulus. So you can only imagine what will happen with no stimulus. Additionally, we do have, this is a chart of disposable income. And as you can see, we saw a peak in April due to the stimulus, and we've been downtrending since then. So disposable income is trending down, and the more we spend, we will have less disposable income to sustain retail sales in the months to come. Furthermore, how about savings? We saw a huge spike in savings in April when everybody panicked and moved some money to their savings reserves. And as the panic and the fear started to ease, you saw consumers taking from their savings and spending out in the economy. And it is very clear that April was a peak and we've been downtrending since then. There will be a point coming very soon, specifically the holiday season, when we will exhaust and deplete our savings reserves. Moreover, US personal income, you saw a pop in April due to the stimulus, and then we gave up, and we had a little pop in the summer due to the rehiring and reopening of some leisure facilities and restaurants, etc. But that is again curling back down, further evident of a peak in September for retail data. And the last bit of information here, this chart is for consumer credit. And you saw consumer credit collapsing in April, recovering from that point going on, and then we saw a dip and curling back downward in August. We will see what happens in September, but of course the prediction is a continuation to the downside. So the V-shape is curling back down, and when you combine all this data, September was probably the peak for retail sales data and consumer purchasing power, and it is only a downhill from this point on with no stimulus. And perhaps this is the reason why the market decided to reverse on Friday. On the face of it, once the data was released in the morning, the market rejoiced. But once we digged into the details, perhaps the market saw things the way I saw them. Of course, remember that we do have over 25 million people right now on some sort of unemployment benefits. So if you're celebrating, saying that the economy is back, retail sales data is up, and we're in a V-shaped recovery and everything is hunky-dory, and it's only a small slice of the population that is suffering, you have your head deep in your ass to think that kind of thinking. And of course, speaking about the great V-shaped recovery and the retail sales and the we're out of the woods thinking, here it is, industrial output came out just a little after we heard from retail sales, and the industrial output came out disappointing, declining very sharply from expectations. And you see the chart right here, right in front of you. We are not doing anything near a V-shaped recovery in industrial output. If anything, we're curling back down to the double dip danger zone that many economists warned us about. Now, retail sales data is a lagging indicator, meaning that you were hearing about something that happened last month. However, industrial output is a leading indicator because manufacturers will decide whether to increase or decrease output based on future forecasts. And of course, more holes on the V-shaped bullshit narrative. The US budget gap exceeded $3 trillion this year, and you see the chart right on the screen. We are now, ladies and gentlemen, going back to numbers we haven't seen since the World War era. Unbelievable. And here is the last headline regarding stimulus, an update about stimulus. Pelosi is now giving the administration and the Senate 48 hours to decide whether they want to make a deal on stimulus or not before the elections. And we know a deal will not happen because Mitch McConnell already taking his bill, the mini skinny deal, the $500 billion deal that only deals primarily for the PPP loan, a new round of PPP loan for all the bastards, cronies, the scam. And he's gonna put that bill on the Senate for a vote this upcoming week. So now we're coming to a point where we are certain, with 100% certainty almost, that we are not gonna have a stimulus before elections. Now, how do you think the market would react to that? If that didn't convince you that the market is a stone cold short at this point, let us move to some charts so I can convince you. Starting with the SPY, the S&P 500. Here's a 15 minutes chart, and as you can see, we had a big reversal on Friday, and now we're looking at support levels for the first support at around 347, and if that doesn't work, we're looking at 344. Of course, we could gap down on Monday in the morning and surpass all these support levels, and we will have to look further down for more support. Now let's switch to a daily perspective of the SPY, starting with the bullish thesis. The bullish thesis says that we had a reverse head and shoulder formation. We blasted to the upside from the right shoulder, and now we're just taking a break. And all we're doing in the big schema picture is a cup and handle formation that is very generally bullish from a technical perspective and will resolve itself to the upside. Now, heed this warning. Please don't pick up a charting book and just follow it like it is the gospel, because all these technical patterns have psychological explanations behind them. And if certain rules in the psychology don't take place, then the pattern will not work. We can discuss that in a separate video because it is a longer topic to discuss. But moving on to the bear case now for the SPY. Number one, we're seeing a potential crossing to the downside in the MACD. Furthermore, we had a huge rally, yet we failed to challenge the September highs. On top of that, we've reversed on Friday before recapturing the former high. All of this information suggests a weakness in the market, a lack of momentum to take us all away to all-time highs, which suggests that the reversal is imminent here. This is at least the bear perspective. And lastly, let's move to a weekly chart for the SPY, and you see the bearish ABC pattern pretty much taking place. The B leg is becoming very clear, and you know that the C leg will follow through if this pattern is correct, which means further downside. What's going on with the Qs, the Nasdaq, from a 15 minutes perspective? You see very clearly that the Qs got rejected from the former trend line. The moment the Qs reached the trend line, you saw a very hard rejection and a reversal. That speaks volume right there. And when we switch to a daily perspective, you can see that we formed a new trend for a little bit. When we look at the MACD, you see a potential crossing to the downside, suggesting that even the new trend is about to be broken to the downside. And when you switch to a weekly perspective, you see the formation of the bearish ABC pattern becoming evidently clear. The Qs certainly is the weak link here when you compare it with the Dow Jones or the S&P 500 or even the IWM, the small caps. And moving on to the Dixie from a weekly perspective, the dollar index, and you can see we talked about bearish ABC pattern in the indices. We're seeing the mirror image here, the reverse of a bullish ABC pattern in the dollar index. We're still at leg B. If we move higher next week, it will become very clear that we are forming the C leg, and the C leg will carry further upside. What about gold? Gold is the mirror image of the dollar. If the dollar is going to do a bullish ABC, then the gold chart here would do a bearish ABC. Of course, we talked about the level of 1925, a solid resistance, and perhaps the stopping point for the B leg and the start of the downward leg, the C leg. Moving on to the VIX weekly perspective. As you can see, the bull flag is still in formation. The resistance, the support of about 25 is very solid at this point. And I do think as we near the elections this week, this upcoming week, will be the VIX is weak, and you see the VIX moving higher out of the bull flag formation. That is my take on my 2 cents. But let's play the devil's advocate here and look at the TNX, the Treasury 10 years yields. Here's a 15 minutes chart, no markings or annotations by me. And here is what I see. Are we shaping a bullish ABC pattern just like we did in the past for the TNX? And if we do, and if yields are going higher, then that would mean the bonds will sell off and the market would be in a risk on mood, so equities will outperform. So again, we have to look at everything and present every piece of the puzzle and every outlook for the market. You have to look at the TNX, whether it is a leading indicator here that the market would rally and treasury yields would drop, or was this just a dead cat bounce in yields and we will continue and see further decline as panic starts to creep in the market and we see selling of equities and buying of bonds. And moving on to the 2 important names of Apple and Tesla. Tesla reporting earnings this upcoming week, but let's start with Apple from a 15 minutes perspective. I did not add any markings on the chart. It looks exactly the same as you saw it on Thursday. We talked about a series of bear flags, and we talked about the bear flag formation on Thursday, another bear flag that should play to the downside. And you saw that happens exactly on Friday, meaning that Apple is seeing a significant amount of weakness here, so let's check on support levels in case the shares continue to drop. This is an hourly perspective now. Support number 1 at 117. Not very solid, the 117. We could gap below it right away and we'll go out of the window. But we do have support number 2 at 113. This is more of a solid support, 113. If that doesn't work, the last line of resistance, in this case support, is 106. Breaking 106 will open the floodgates and will pave way to the domino effect crash in Apple and the Nasdaq in general. Let's move on to a weekly perspective. We see a bear flag formation here in Apple. And let's pause here and discuss something. On Thursday, I had some spare time and I was watching some technical analysis on YouTube from different YouTubers. And the consensus here that Thursday was a reversal, we found a bottom, and now we will march higher and the bull run will continue. Almost all of them fell into the bull trap, assuming that we found a bottom on Thursday and we will continue to march higher. Of course, no mention whatsoever of the dollar index or any of the quality analysis we do in this channel. Furthermore, the consensus here when they look at the Nasdaq chart is that we're seeing a cup and handle formation that will resolve the further upside. I disagree because there is no Qs or Nasdaq without Apple. Look at Apple's chart. Does this look like a cup and handle formation to you? No. It looks a lot weaker than that. It actually looks like a bear flag, and if Apple falls, the Qs will fall, and there is no cup and handle formation. So be careful here who you listen to and the quality of the analysis. Of course, none of us know what will happen next in the market, but at least here we gather as many information as we can to avoid falling into traps. Now, to the last chart of Tesla, let's move on to a 15 minutes perspective. Right away, you see the 453 number being very important as I predicted before the week even started. So do I know my numbers or what? Because you see, the 453 was a pivotal point here for the chart. Tesla struggled to break above it and it got rejected, very hard rejection here. And you saw Tesla sliding further to the downside from that point of rejection. So let's take a look at some support levels here. The first support at 438.50, second support at 434. And the third support, if the upper support level don't work, we do have 425.30 in and around this zone should be an okay support level. But remember, when we look at a weekly chart of Tesla, it's not looking good at all. It is looking just like Apple doing a bear flag formation. We do have earnings coming and we know Tesla is spending a lot of money in the Berlin and Texas factories, so their profit levels will come very, very weak. That could spook the market, spook a lot of investors, and cause a very big slide in Tesla shares. Combine that knowledge with, of course, the options activities we've seen throughout the last 2 months. Option riders accumulated a massive amount of shares of Tesla, and if there's any bad news in earnings, they will control the market. They will dump a massive amount of Tesla shares, and you will see a very, very significant slide here. I remain bearish in Tesla and I remain holding my put options in the name. And now let's move on to conclude the video. We do have an important earnings week coming, and I'll do a separate video on earnings. The video will be out in the morning, so we'll have plenty of time to watch it. I know Monday we don't have any important earnings at all. We only have IBM. Most of you are not trading IBM here, so we're not going to miss out on anything if you watch the video after the market closing on Monday. I'll try to get it out there as soon as I can. But here's the perhaps more important point. We talk about the Robinhoodians controlling the market, gambling by margin, buying stocks, buying call options. It's been fun and games for them for a few months. And here we are, the game comes to an end. Robinhood has decided to up their margin requirements due to the upcoming volatility in the elections season. Of course, if you have Charles Schwab or E-Trade or any other broker, they've already sent you the notice that they upped the margin requirements. But it is not a problem for Schwab traders and interactive brokers, etc. Because these are professional or more experienced traders. They know that they have to up their reserves during the upcoming elections volatility. The Robinhoodians are a different story, and you're going to see them now scrambling because it was a short notice, and on Friday we started seeing massive amount of margin calls, and if by next week the Robinhoodians don't cover their margin requirement by adding more cash, we know that they're using margin to begin with because the lack of cash in their accounts, and they're gambling severely in call options. So if they do not meet the requirement, Robinhood will start selling their shares, whatever shares or options they have. Furthermore, even the disciplined Robinhoodians and let's say informed Robinhood traders who use Robinhood but they're not Robinhoodians, they will have to sell some shares to meet the margin requirement. So expect a massive amount and a massive activity in selling the popular shares, in this case Apple, Amazon, Tesla, the crowd's favorite, to raise cash to meet the margin requirement. This is a very important and pivotal point for the market here, so be cautious and prepare yourself for massive wave of volatility.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.